Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next 20 minutes here on Options Guide TV. It's going to be short and sweet, as it has been recently with Options Guide TV. We're going into September. We're looking at a rate cut in September, and hopefully that will keep the seasonality out of the marketplace a little bit. That we do get that rate cut. Right now, next week, the Fed and Chair Powell are going to be giving some comments on the marketplace at Jackson Hole, their annual meeting. Now, there's no expectations of an emergency rate cut. We talked about that for a second because the markets declined. But now the futures market, as of now, is showing that there is a 40% chance for a 50 basis point rate cut in the Fed funds rate. And there is obviously 60, well, I shouldn't say obviously, but then there's a 60% chance that they'll go at least 25 basis points. Right now, the markets seem to have been calmed by that. The VIXs came off. We did a lot of bearish VIX trades. And if you have any questions about the VIX trades, please do put them in the chat box, and I'm happy to address them. You can do that inside the Tradier Hub if you are logged in. You have to have a login and a sign in, and then you can ask questions. And then also inside the Tradier YouTube channel, obviously you have to be signed into YouTube to do that. So with that mentioned, as far as the VIX is concerned, I promised to get an article out about the VIX. It told when I'm doing a lot of the VIX trades, I'd like to reference this article. I didn't get it out last week because I was a little bit under the weather, to be blunt. And I'm finally back in the saddle again, feeling a little bit better. I still have a little nagging cough that's kind of hanging around. But I do still plan on posting that first on x.com and then inside the Tradier Hub. The VIX article that explains all the intricacies of trading VIX options. It's definitely a different beast. And with our trades, we actually, with a lot of them, we would have went to settlement on them. And both of the trades worked out just fine. And you can listen to Monday's show. I discussed both of those trades. Friday, I just couldn't do a show. I just couldn't pull it off. But that was that Friday was actually a good day relative to some of the earnings trades and other VIX trades that we actually put on here on Options Guide TV. So back in the saddle, here we go. I don't want to get long the market. And the seasonality thing is real in September and October. Even looking at what the VIX does in September and October, over time, over years and years and years, there's always been a general upward trend in the VIX, and we'll probably buy some VIX call options going before we get to September. But it's August 14th, 2024. It's a Wednesday. I'm still not ready to jump on that bandwagon yet because VIX premium is expensive. So we will eventually look at doing a few more VIX trades. It's going to try to say what has happened in the past may happen again in the future, even though it's no guarantee. But that's what we're going to look at doing going into September. Last year at this time, we avoided September and October as far as getting into a long portfolio of option contracts. And in November, we took a few positions on, and those positions turned out well, quite a few of them. I actually don't know. Well, we did IWM. IWM was probably our worst trade per se to just get long the market. The market is up since that point in time. It's trading higher, but the long-term deep in the money option contracts didn't turn out as well. But we did Eli Lilly, we did Caterpillar, we did NVIDIA, of course, and we rolled that position quite a few times. Lilly quite a few times. We did Google back then. So everything turned out really well. We'll probably end up doing something like that again. The big unknown, or the big event that needs to happen to let the markets be free, is the huge election that's going to be happening in November. And I think in general, just need the uncertainty of the event to be gone. And I think that will free up the markets a little bit. We'll see where we're at. Not a lot of talks. Well, I don't know if Americans have moved on this or not, but the geopolitical concerns are really the biggest concerns right now as far as the economy, especially what's going on in Israel. But the Ukraine and Russia conflict is there. It's real. It's happening, and that doesn't make the nightly news anymore. But it's still a very big component of what's going on in the world and the economies in general. Okay, so there's enough of my diatribe of what we're going into at the end of the year. So I'm going to make it simple today. We're going to look at Walmart ahead of earnings. And I think Walmart this is going to be a big earnings report for Walmart, because the retail consumer is the persons that have kept this economy afloat. The spending, the fact that we've still had fairly strong, well, not fairly, we've had strong wage growth overall, and that consumer continues to spend. We've seen some signs of that waning a little bit. So I think a big thing with Walmart is going to be their projections going forward on the state of the consumer. Walmart has, they've done very well to keep afloat, going up against Amazon. They've gotten much better on their retail presence online, and in an economy where some people might perceive that we are going into a recession, or that now we're in a bumpy landing as opposed to a soft landing, Walmart's earnings are just going to be important. So what I want to do with Walmart is more of a fear of missing out. I wouldn't mind getting long Walmart if we weren't going into the seasonality of the marketplace, and had, a rough month so far in August, and then you got September and October. But I want to get long going into earnings. I just don't want to pay a lot to do that. So I'm going to do a trade that is going to try to take advantage of some of the volatility in the short term on Walmart. Now, Walmart is not a volatile stock, even around earnings. It doesn't make wild swings. So I do want to buy a call option, but I don't want to pay full price for that call option. So what we're going to do is actually sell a put spread to pay for that call option. Inside the options playbook, inside my book, we don't have a specific trade for that. We don't have a name for that strategy. But I don't mind doing that trade, having limited concerns about the downside on Walmart. The economy, we're going to try to go out around the expected move to the downside to try to generate some capital to pay for a potential move to the upside. And that's where we're going to go. So with that said, let's run to the Tradier Pro software, and let's see what's going on in the markets right now. So here's the VIX. Wow, it even dropped below 17. Okay, so the VIX is at 1674. Kind of a mixed marketplace. IWM is the Russell 2000 index. That's down about 1%. We got the NASDAQ flat, let's call it, and SPX flat, let's call it. So mixed markets for sure. We on Walmart, we're up about 1%. So that's a strong move. They're announcing earnings before the open tomorrow. So I'm going to actually go out to the August 23rd expiration, which gives us 9 days for this trade to live. We're going to look to sell a put spread on the downside. That means we got, and I actually wouldn't, even if I got put the stock, I wouldn't mind buying it lower if it happens in that range. And then we're going to use that to actually pay for an out of the money call option. So we'll have limited risk and known risk on the downside, and we'll have unlimited upside potential. Now, if we go back and we look at a chart in Walmart, I just was going back. This goes back to June, a very straightforward chart, just kind of zoomed in on it. But if you look at the swing just from this time frame, right? So here, let's go here, 66 all the way down here. So this is the low end of the range going all the way back to the beginning of June 4th, all the way up to the high end of the range, 71. That's about a 5-point swing. So the market is no, and there's an earnings in the middle of here. That was a 2-point swing. I know it looks dramatic, but that was from 68 all the way up to 70. So that's only a 2-point swing in that scenario. If we go back and look at the expected move, we got to look at the August contract. Okay, so the August contract would be for 2 days. And remember, I've mentioned this on the show a lot. It's always the expected move for that expiration period. So this means we're not talking about just after earnings. We're talking about the Friday after at the close expiration and what the marketplace may move relative to that. 68 is here, so 69 is the closest one. You're looking at $4 would be the maximum we'd say. So let's do the math. So 166 is the ask on the call side. 216 is the ask on the put side. 382 divided by 68.61. So we're talking about a 5% move. But you're looking at a $4 move is the expected move on that. Now, based off of the chart that we just saw, you want to sell that move. The marketplace in general has moved less over since going all the way back to June, as opposed to what it's expected to move tomorrow. Okay, so I'm going to do the August expiration. Now, the August expiration, it doesn't change much, actually. 175 on the ask, 275. Yeah, and we're looking at about $4. Exactly $4 if you just go ask to ask. So you're not talking about too much more of a move. So on the downside, that expected move would be right at 65. I want to bring in some premium, so I'm going to sell that 65 and kind of expecting it that if it did come down, then it's not going to go below that range. I'm hoping that obviously if you get some bad news, anything can happen with earnings. There's no way of knowing what exactly their earnings report is going to be. So we're going to sell this option contract, go down 2 points, and we're going to buy that option contract. All right, so that's going to bring in 35 cents to our account. It was 45 cents a second ago. We're at 69.55. All right, well, that gives us a little less. I was hoping to get a little bit more of a credit on that, but I'm still going to ride with it. So we're 35 cents net credit. We are dealing, obviously, with live markets while we're taping the show. And then on the upside, you're looking at a 4-point move is what, a little less than 4 points. So if you do that, you're talking about 73 would be where that 4-point move would be at. And that's if it made that expected move, had a good earnings report. We saw the one earnings report, we moved a couple of points. So that's a strong move for Walmart. So if you get that 5% move and you can get it to the upside, we're going to take this credit, turn around. We're going to buy something that's within the expected move. We're going to buy this option contract, which is the 65 call option. So we're going to add this to our trade. And now we're looking at a net debit of 30 cents to the account. Now we're going to do this on a one-time basis. We have additional risk beyond the debit. So the difference between the strikes here, this is $2. So you got $2 plus the net debit of 30 cents is $2.30. That's your total risk. But what I'm really concerned about here is the 30 cents or the net debit that we paid for it, which is 30 cents. So this entire trade, this entire gaggle of options would cost us $30 plus commission to put on the trade. I think it works a little bit easier if we go to the Tradier Pro what if calculator and we highlight this. It shows a lot better what our outlook is on this underlying. Now, we need it to move at least the expected move. So I would never just buy this call outright. We're getting it for half price is what my concept is. If we stay within this range, we only lose that 30 cents, right? If we go down below 65, well, we have the risk. So if we move more than the expected move to the downside, all the way down to 63, which would be about a 1 standard deviation move after that earnings, we would lose the maximum, which was $2.30. Hopefully we can get up towards the 73 range. Break even in this scenario would be the strike of 72 plus the 30 cents. So $72.30 is where we at least hope the stock can make it to. If not, then it's somewhere in this range, and this is going to be a trade. And we got 9 days remaining. So you can just let it ride. But if you're doing this trade, if it doesn't make it to that break-even point, expectations would be to lose the 30 cents net debit that you put into the trade. We've managed our risk by selling the put spread and paying for the call, dealing with implied volatility issues. So I'm not looking at this trade hoping that I can salvage a dime on the trade. Feel free if you think it's trading for, if it opens and it opens somewhere in this range and it's not going anywhere, well, yeah, if you want to get out, feel free to get out and try to salvage 15 cents or so. But that's not the way that I would approach this trade. Now, we're only looking at a one lot here, a 1 by 1 by 1. So the entire unit is $30 to put on, plus any fees that you want to do. But this is, once again, 100% an earnings play. Not really interested in getting long the market at all going into September. And so I want to continue to try to find some interesting earnings plays that we can put on going into the end of the month. And then we want to do a couple of VIX trades. So if you have any questions, please let me know in the chat box. If not, I'm going to go back to the trading screen, and I'm going to give you an official read back for the paper trade ahead of Walmart going into their earnings report tomorrow. Now, as always, you can adjust this trade, wait till a little bit closer to the close, and just make it all about the earnings if you want. And you take the same concepts and just try to apply them to the trade. But that's the way that I usually would approach it, right? You would want to do this maybe a little closer to the close. Walmart is actually having a strong day relative to the market. Okay, so we are going to buy the August 23rd 72 strike call. At the same time, sell that same expiration 63 strike put, and then buy our protection. We're going to buy the August 23rd 65 strike put. We're going to do this for a net debit to the account of $30. We have a $2 additional margin requirement because of the short put spread. So the total margin to put the trade on, if you are approved for spread trading, would be $30 plus any fees to put on that trade. Your total risk would be $230 on this trade. All right. That's it for this edition. Yep, I don't see any comments. That's it for this edition of Options Guide TV. Feels good to be back in the saddle again. We'll be back on Friday, and we'll look at how the Walmart trade has done. We're going to be getting some comments from Jackson Hole and the Fed. So, well, that's going to be next week. I apologize, not on Friday. I think the comments after the earnings report, the conference call, will be really big with Walmart on the state of the consumer. Thanks for stopping in. We'll see you this Friday at 11 a.m. Eastern time for the next edition of Options Guide TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.